Earnings season is officially here, with financials, specifically JP Morgan, kicking things off on a strong note Friday morning, bringing in new all-time highs for the S&P 500. The Nasdaq side is still technically lagging, but the chart does look good for a potential catch-up trade, noting the recent strength in semiconductors. So welcome to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a solid green-bodied bar with just a little bit of a lower wick, which, if anything, would imply that buyers stepped up towards the lows and they were able to close near the highs of the weekly range, which of course is bullish. If we're thinking about location on the bar-to-bar count, we see a higher low as well as a higher high and a brand new all-time high close, also bullish. Now keep in mind that all of this is taking place over the weekly breakout level. In last Saturday's episode, we had talked about how previous resistance started to act as newfound support in the lower wick of the weekly hammer. And therefore, the odds of a weekly look above and fail to threaten a trend change had dramatically been reduced, and we were taking a more bullish approach on the higher time frame chart. Now, clearly that's paid off, and we've produced a higher high, a new all-time high, and the trend remains in the upward direction. So it's not a shock when we take a look at the anchored VWAP spread that we're above the entire cluster. But what we should reevaluate is the Fibonacci 38.2 coming from the pullback low to the most recent all-time high. And what you'll notice here is that you're getting better confluence out of the 38.2 and the anchored VWAP. But even more important is if we extend this off to the left, it's now spot on with the weekly structure here. Previous resistance is now the 38.2. Now, I want to be crystal clear that there's absolutely zero indication of a weekly pullback looking imminent. There's no large upper wick, and we didn't close back down inside of the previous week's range. However, if a pullback were to emerge, something that looks like this would really start to act as the weekly higher low line in the sand. That level is around 564.75 if you want to use the Fibonacci 38.2. On the daily chart, we'll see 566, and we're really looking at lows, higher lows, and the possibility of higher lows here, pulling back from the highest high in the trend count. Let's quickly take a look at the volume profile on the weekly, and of course, we're above the entire high volume node cluster up here, which makes a lot of sense, so there's not much to aim at as we're moving into blue sky territories. Unless, of course, we start taking a look through the lens of some Fibonacci extensions. From this pullback low to the high to the pullback low over here, we know that we've got roughly 610 as a measured move target. And this is important because if we take a look at the monthly time frame chart and move from the sickness low to this high, to this pullback low from the lows of 2022, we know that there's some pretty decent confluence there at 610. Now, the argument is not that we make it there over the next 5 trading days or even 10 trading days, 2 weeks. But generally, as we're moving into uncharted territory, it can potentially act as a target. Once again, this is 610 here on the higher time frame charts as a measured move target. Let's start to get more granular on the SPY daily time frame, and let's really zoom in here so we can see this week's expected move. If you're not familiar with the expected move, it's this box right here. You can check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 588.44, and that of course would imply a brand new all-time high and a higher high in the trend count. That's bullish. And if we're contained by the lower bound, the number's at 570.76, implying a higher low in the trend count, also bullish. But my one slight concern here is that it's ever so slightly underneath 572. And 572 to me is really the daily higher low line in the sand. Why is that the case? Because of course we know this was a excruciatingly painful balance range where the market really did nothing inside of this box. So if we're going to judge this as a successful breakout of the balance range, I really don't want to see price underneath 572. Now, of course, the trend is up and we're sitting on the highest high in the trend count, so it's very reasonable that a pullback could emerge here, and notice that there are plenty of spots for us to potentially find a higher low well above 572. If we're thinking about structure, of course, Friday, strong break in the upward direction, but what did it come from? This, of course, was a bullish 3-bar play with an inside doji on Thursday. We broke through the 2 equal highs, and we've closed near the highs on Friday's range. So again, buyers are totally in control here. The most picture-perfect bullish consolidation would take place over these 2 highs. The number is 577.15. Consolidation that looks like this, and continuation into blue sky territories. That would be fantastic. If we pull back deeper than that, I'm still willing to entertain long opportunities off of this. Previous quadruple top, 1, 2, 3, 4 back here, that's at 574.40. It's the low of the Thursday range for the inside bar. I'd still consider that an opportunity for a daily higher low if we find buyers above. So that's also bullish for the pullback. Then last but not least is the line in the sand, the top end of the balance range from in here at 572. That's absolutely the line in the sand, so I would really have to see something that maybe looks like this, daily higher low, and we're looking for a continuation play in the upward direction. So as we're navigating into blue sky territories, charts are typically more bullish than bearish until proven otherwise. But where would I change my tone? The upside takes care of itself. What about the downside, right? Where do we really start to have to say, okay, this is not really playing out perfectly? Well, of course, it's just all about 572. If this turns into a huge failed breakout and there's a move under 572 with a lower high here, absolutely I'm concerned, and I would really start thinking about targeting the bottom end of the balance here at 566. Now, why is this an issue? Because we just talked about how on the weekly time frame chart, that is also an absolute line in the sand for a weekly higher low. What do we notice about this level? It's pretty precise with lows, previous lows, previous lows, so therefore it's a mechanical level. On the first test, I'd really expect a breakdown of 566, especially if this is all going to start acting as overhead supply. Now again, we're talking about downside back pocket what if situations, but let's reel it back. Let's talk about trend. Let's talk about candle structure. Bullish trend sitting on the highest high with a strong close at the top of the range on Friday's session. So is this a primary outcome? Is this really what I'm looking for early on in the upcoming week? Absolutely not. We just need to know where we need to change our mindset if the market does decide to deteriorate in the downward direction. I really think that we want to try to be pullback buyers before we're trying to short this market, as it's clearly making a strong move into blue sky territories. And I also want to point out here, as a measured move target, if we're just thinking about this as a balance range, typically we try to double that range in the upward direction as a measured move target, which would take you closer to 583 in the upward direction. So let's just say that we get early week continuation and start to slow down here, midweek per se. It wouldn't be unreasonable that if we pull back, once again, there's plenty of room for a daily higher low to emerge. So just something to have on your radar as a measured move target. Once again, I would not bet the farm. I would not be shorting the market as we approach 583. It's just something to consider from a range doubling perspective. Let's move on down to the hourly chart. Let's get granular here and really start to see what's going on. So once again, upside takes care of itself. You've got a balance range happening here. Beautiful holds. What was once resistance is acting as support in the flag into the end of the week. Friday comes along and confirms the breakout. Value is, of course, shifting in the upward direction. We'll see that on the market profile in just a moment. The chart's bullish. The hourly trend is absolutely in the upward direction. Now, you could start to suggest that maybe you could be interested in a trend reversal on the hourly if you get a lower high underneath this breakout point. If there's a lower high on the hourly underneath 577.15, it might not be unreasonable for that pullback to really emerge towards that 572. Remember that for a daily higher low to be a firm daily higher low, for it to really count in the trend sequence, you need an hourly downtrend. So this really isn't all that bad. If you're trying to trade for the pullback outcome, I would at least want to see this lower high right here. So keep in mind, once again, this is counter trend to the strength that we've seen on the weekly, counter trend to the strength that we've seen even on the daily, and counter trend to what we're seeing, the strength here in the breakout of the balance range, even on the hourly, right? You have lows, higher lows, and along the way highs, higher highs, and the highest highs up here. So with that said, the primary outcomes, once again, just to get into the pathing and keep it bullish first and bearish second, this absolutely is bullish consolidation. Brigade bolts over these highs right here around 580. Blue sky territories looking for further upside. If you get this lower high, I mean, you could try for shorts from A to B, but just understand that it's a counter trend move. You're not really looking for a huge outcome to the downside there. At point B, I would still evaluate and say, okay, if buyers step up here and this turns into a double bottom, really interested in buying the pullback that holds previous resistance as potential newfound support once again. We've done it once, maybe it happens twice. If we go through 574.40, once again, keep in mind that this also is a bullish spot for potential reversals off of 572, and that's the line in the sand that we've been talking about. So how might you get involved in this? If you're somewhat skeptical on the retest of 572, you probably just want to trade the Brigade bolt back over the 574.40, right? And then, of course, let's bring out the red crayon for the, oh my goodness, the bears will have an edge, and I will change my tone if we're getting lower high price acceptance underneath 572. But it doesn't really seem like that is a higher probability outcome for a couple of reasons. I want to come in with the Fibonacci's from the bottom end of the range up to the most recent high. The 38.2 is stacked right here at 574.40, reinforcing this level. We could also come in with the intraday anchored VWAPs, and what you'll notice is that this right here is really looking like a decent area of support. Remember that this was the gap up to all-time highs. It's now acting as support or potential support around 572, offering super support on that level. We also have this from the breakout day on Tuesday that is going to be creeping in the upward direction. Let's just say that over time we get consolidation, really reinforces the idea that 577.15 could also be thought of as a pretty strong area of potential support to keep the trend in the upward direction. The other reasons why I really don't feel as though a huge reversal underneath 572 is in the cards early on in the week is simply because if we take a look at the market internals, and if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Recall on Wednesday's episode, Tuesday's breakout, right? Wednesday even getting a move in the upward direction, we had sort of made note that the internals were pretty lackluster. We never really saw strong volume inflows, advanced decliners, or even cumulative builds on the tick. Well, what did we get on Friday? Certainly not over 300 million, but much closer compared to the Wednesday session back here. If we look at the advanced decline line, getting towards trend higher zone, the intraday index score was much stronger than anything else we'd seen all week, and the cumulative build actually closes positive instead of back down towards the zero line like what we saw on Wednesday. So are new money buyers starting to step up as we're breaking out to new all-time highs with the resolution of CPI, moving in the upward direction here? Sure. Absolutely, this looks far more convincing on Friday's breakout than it did on Wednesday. Let's take a quick peek over at the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. We talked about how Wednesday's P-shaped profile was slightly concerning. It, of course, represents more short covering off of the open here. And you do also have a P-shaped profile on the Friday session. The only difference is that the market internals are more suggestive of buyers across the exchange versus on Wednesday when, it really did look more so like short covering. So the fact that value has moved from here, this is Thursday's inside bar, right? Over, notice that Friday's value is over the two equal highs, that does strike me as a bullish advance in the upward direction. And we've also left a poor high on Friday's high of day. So what do we know about poor highs? They technically don't mark the proper end of the auction. That would sort of imply that we need to clean up that level, meaning we're looking for further upside, right? I would change my tone out of this chart if value really progressed. Let's say on Monday there's a liquidation break. If value gets underneath this area right around in here, around 58.05 in the futures, basically Thursday's low, which as we just saw on the candlestick charts, let's go back over here to the spiders, it's going to be your 574.40. If value gets underneath that from the market profile, that's where I would really be thinking about, okay, 572 is going to get tested, it's going to get tested firmly, and we need to see that resolve in the upward direction if we're going to maintain this more bullish stance. If value in the second half of this week is underneath 572, underneath 5800 basically in the ES futures, I'd be much more concerned about looking for possible follow-through in the upward direction. Let's jump on over to the Nasdaq and see what's going on with the QQQ. We'll jump it up to a weekly time frame chart to begin with, and we'll do the same top-down approach happening over here. What I like about the Nasdaq, let's keep it simple first. So candle structure and location, then we'll dive into what I like. Of course, very similar to the S&P 500, solid green-bodied bar, a little bit of a lower wick, buyer stepping up at the lows, closing near the highs. The bar-to-bar count did produce a higher low as well as a higher high, closing outside of the previous week's range, but right at the highs of the previous week's range. What I was going to say I like most about this is that we continue to use the neckline of the overall double bottom reversal pattern here as support. The lower wick did find buyers off of that level, and we've got a much stronger close here in the upward direction. So the trend does look constructive for lows. Higher lows are being found near the neckline of this key pattern that we were just talking about. Now, of course, in the intro, we mentioned that the Nasdaq is lagging. It's not printing new all-time highs, and you've got highs hanging out up here. So there's absolutely the potential, considering that we are seeing buyers step up near these key areas, there's the potential that this catches up to the S&P 500 via some sort of move in the upward direction to tag up to the all-time high. And that's really what we would look for here out of the QQQ weekly chart, trying to target something like 503.30s, 503.25 as the all-time high here. As long as we're over this neckline, which is closer to 481, 482, we're all set on the weekly time frame. We're still in a technical uptrend here on the weekly. Let's check in on the anchored view apps for the Nasdaq and see what's going on. Of course, above the entire cluster, that is bullish. If we come in with the Fibonacci's from the low up to the most recent high, not much of a change here, but still over the Fibonacci 38.2. It checks out as being more bullish than, of course, it is bearish. Let's quickly check in on the volume profile. This might give us a little bit more of an insight. We'll drop this down to something like a 3-month time frame chart. Sorry, not 3-month, but maybe 6-month will do. There we are. And what we just want to evaluate is where are we relative to this high volume node. Look at the close strongly over the high volume node. So I like that as bullish progress in the upward direction. Again, as we start targeting these all-time highs, the volume taper is pretty substantial. So that's bullish, right, as we're moving towards it. Let's drop this down to a daily time frame chart. Let's get even more granular here out of the Nasdaq and see what's going on from this point of view. What I like about the trend here is, of course, that it's up, but we're just hovering near these equal highs. There hasn't been a real attempt and a strong daily close over the level that then closes back below. That would be much more concerning for, on the daily scale, a look above and fail, kind of like we had described on the S&P weekly, where if we made the move above and then came back down below, that's concerning for a reversal. But because the chart's just sort of like bubbling right up against this level, it's continuously producing lows lows happening up here, it looks more to me like an ascending triangle with the opportunity to break out, maybe a retest above, and continue towards that all-time high, 503.25. So I like the catch-up trade here out of the QQQ, so long as any daily pullbacks hold up over this level right here. 486 is the must-hold level. Now, there are some more nuanced levels in here. We'll talk about them on the hourly, but generally speaking, this is still okay. You've got soft lows, higher lows here. You could find firm higher lows over 486. Another subsequent test, especially in short proximity of time of 493.10, should open the door for a breakout here. And once again, this is the catch-up trade, ultimately targeting the all-time high on the QQQ Nasdaq, 503.25, on that break of 493.10. I would really start to become more concerned about the Nasdaq if we're getting price acceptance underneath this 486. Something that pulls back, does not find support here, and slips underneath. Now, all of a sudden, I think we can all agree that the pattern starts to look much more like a potential double top, and then a break under the neckline gets pretty dangerous because that is not going to be a hold of your weekly double bottom neckline, right? You're well underneath that at that point. This would be bearish consolidation under the 486, and the door is open for much more substantial downside below 477. Once again, this is a back pocket situation. I want you to be prepared for when you have to change your tone, if we have to change our tone underneath these levels. But as of right now, bullish until proven otherwise. I like the multiple just sort of sideways consolidation bars up here, looking for higher on the break of 493.10. Let's drop it down to an hourly chart here on the Nasdaq and see what's going on. So, very simple pattern here is, of course, bull pennant, something that looks along these lines. The resolution of 493.10, we've got our upside. So let's take a little bit more of a nuanced approach and talk about this 490.60 level, because we can see that that has acted as previous resistance back here, newfound support off of the open on Thursday, newfound support on Friday, reinforcing that same level. I would tend to think that these traders, longs in this consolidation, would throw in the towel and potentially close out underneath 490.60. So if this consolidation persists early in the week and we get a break and lower high under 490.60, I wouldn't be afraid of the hourly downtrend that could potentially ensue towards this zone here. And I want to call this out as a zone absolutely, because on the daily we had talked about how 486 is the key level, but also notice here how previous resistance acted as perfect support off of 487.75 early in the session on that Wednesday, right? So I would really be a pullback buyer looking for bullish opportunities in this zone and not aggressively short when we approach it. So don't get me wrong. Is there a potential short from, let's label it, let's say point A here to zone B down below? Sure, absolutely. Intraday traders can try to take advantage of this range, but generally speaking, I would maintain more of a bullish stance for the possible retest and higher low on the daily over 486 if we see that breakdown in the first place. The upside takes care of itself, just like we talked about in the S&P 500. If we are consolidating up here, bullish until proven otherwise, looking for upside targets 499.50, then of course the all-time high at 503.25. Let's quickly check in on the intraday anchored view apps. Notice that we are above the entire cluster. The breakout day is acting as support here on Thursday and Friday, and 486 is confluence with the gap up, very similar to what we had described over in the S&P 500. Quickly checking in on the Fibonacci's intraday. Let's come from the low of the pullback. This is basically the same thing we did on the S&P just to stay congruent. 61.8 is the 486 level. Remember that the 61.8 is always your absolute line in the sand in terms of 100% retracement of the move that you're evaluating. So if we're underneath 486, I would really think that it's a snappy move into this level, which, look at that, you are getting some confluence there out of the Anchored View app currently. Let's take a quick look at what's going on with the Nasdaq side of the internals. Are they as strong as the S&P? Weaker? Even stronger? What's going on here? So you can see decent volume inflows in trend higher zone firmly, and a cumulative build that's much more solid and smooth than what we saw out of the S&P 500. This honestly, once again, supports more of new money buyers coming into the Nasdaq with that semiconductor strength. I think that it's poised quite well for the catch-up trade to play out, and we'll talk about the SMH when we get to the sectors. But let's finish up the Nasdaq with, of course, our market profile view here. And we'll probably have to do some of this. Let's make it a little nicer on the screen. Just generally pointing out that value is still high here. You're getting, progress in the upward direction. This is completely contained within. This is overlapping to up on Friday. You do have that poor high on Friday. You've got decent excess lows here. This kind of lacks material excess at the bottom end of the Friday session, but generally speaking, I like that value is holding up higher. It's not skewed lower in the profile. Yes, it does mean that the chart can get top heavy if we do start to take out the two equal lows, really this zone right here around, let's just call it 20,300 on the Nasdaq futures. If you get this, it's the same pullback we had just described over in the QQQ cash, and we're probably looking at the retest of that infamous 20,175 level right around in here that we would want to start to see acting as very firm support for the possibility of a daily higher low. Just to be, again, very transparent between the two indices, the futures versus the QQQ cash, exactly what we just talked about is this right here. So this, you get maybe some value that's top heavy, you break down, you pull back. This is the equivalent in this zone, basically, of 20,175 over on the NQ futures. With that, we'll jump on over to the Rusty Russell, our small caps, to finish up the broad market ETFs. What do we see out of? Let's go to the weekly chart here. What do we see out of the weekly chart? Clean drawing set, please. We've got ourselves, in terms of candle structure, nice little hammer candle here. It's a little bit less of a body than what we've seen out of the S&P and the Nasdaq, but nonetheless, it's still bullish. On the bar-to-bar count, very, very nuanced here, but there is technically a lower low as well as a lower high. It almost looks like an inside bar, and for all intents and purposes, you're really just getting some sideways consolidation right here. It's not really a breakdown, but I do like the hammer structure. What that tells us is that buyers are clearly responding to this area, and one of the reasons I like it so much is because this is a clear higher low opportunity over the previous balance range from back here. If you're making progress on the weekly chart, which would start to avoid the recession theme, especially out of small caps, then ideally price acceptance is over this 210 zone, and that's exactly what we've seen here on the weekly bar-to-bar count. So looking good from that perspective. If we quickly check in on the Fibonacci's, we come from the top of this move to the pullback low over here. You're over the 61.8. If you inverted it, of course, it would be the 38.2. And that, of course, is more bullish than bearish. The more time we spend up here, the more likely it is over time we get the 100% retracement. Let's clean that up. Let's come on over to our Anchored View app spread out of the small caps, continuing to act as support from the top end and the bottom end of those two levels we just used, the high and the low from the the Fibonacci spread we were just looking at. So I would still say that the buyers are making a stand here, trying to offer a weekly higher low, right? You have lows, higher lows, potential for higher lows. They're holding right now as higher lows. The next big step is forming some kind of equal high up here towards that previous breakout high. Let's take it on down to the daily time frame. I guess we'll go to the volume profile. Let's be congruent. Let's take a look here. Let's zoom out on this. What I want to just point out is that we're continually closing over, or continuously staying near this high volume node. Resolving that to the upside would bring in some thin structure retracement. I do have to bring in another, let's go like a 4-year chart so we can see that high a little bit better. If we were to get a target in the upward direction, I would start thinking about this up here, closer to 233, I believe. Yes, 233 is that upside. If we can push firmly away from this high volume node, getting something that would look more so like this. So with a bit more time, considering this consolidation back here, I suppose we're right at the high volume node. It depends on if you're a believer that we still have old business in here who is yet to transact, and you're still worried about that. If you're looking at newer money transactions, less of an issue, and as we just saw, we technically closed over the high volume node. Let's bring it on down to a daily time frame chart. Hopefully I didn't lose anyone too much on that volume explanation, but what do we see on the daily chart for the IWM? Certainly looking better with the Friday move. Friday is really substantial because what it does is it basically triggers what I would consider here a very maybe odd-looking double bottom, but nonetheless, you did support once and twice over 215, which I'm arguing is the daily line in the sand based on this previous consolidation. And you broke the neckline there on Friday via the rally in the upward direction. So small caps here making this advance absolutely is going to help the case for the S&P 500 to continue in the upward direction. So as we're looking at the small caps going forward, you just want to see that neckline act as support, aka 218.50 acts as a potential higher low, higher low, and you start working your way up towards this area up here. Now, am I going to sit here and say that this is the strongest trend I've ever seen out of small caps? Absolutely not. If we're really just thinking about this box right here, the market's been more balanced in a range than anything else, so the best outcomes here for the small caps would really be if we could clear this 225.25. The reason I would say that, not the exact high of this upper wick, is just because of the way that the market had consolidated here and clearly rejected that same level. It's also very close to the upper edge of this week's expected move. So far, neutral to bullish with the hold of 215 and the daily 50 SMA out of small caps. Certainly an opportunity, and as we just explored on the weekly, for a higher low. And remember, what goes straight up comes straight down, goes straight up, comes straight down, goes straight up. As long as we're over 215, I would tend to think that we're doing all right. If we break 215, obviously much larger concerns emerge. For small caps, I would start to expect it wouldn't be unreasonable for 207.80 sooner rather than later if, again, there's that keyword if, we break underneath 215. So far, neutral to bullish on the daily. Let's get on down to the hourly chart here and see what's going on. So pretty much a short squeeze right out of the gates on that Friday morning session. Boom, straight to the upside. What I like about it, at least, is that the Thursday session had closed as a bullish hammer candle off of support. So just from a very classic technical setup perspective, break a hammer high, get continuation in the upward direction, absolutely. More bullish than bearish. As we walk forward, and as we can probably all agree together, this is kind of a choppy balance range. The market was not really doing much on these individual sessions. It was down and up, down and down, up and down, all over the place, kind of just not really making much progress though. I think we can agree that if we stay over 218.50, it's a solid opportunity for an hourly higher low, which would then keep us engaged with the daily double bottom 1 and 2, sort of over the neckline area in here. So watching that very closely, 218.50. Let's quickly throw a fib on from the bottom of the Thursday move to the most recent high. Just wanted to see where the 38.2 is in regard to that. It's close, and I would honestly say it wouldn't be unreasonable to use these highs here, which is a little bit higher, around 219.25, I think is the level. Yeah, 219.30, 219.25. Wouldn't be unreasonable to call that the key area to hold above, but just based on the way that we've interacted off of 218.50 in the past, really from previous resistance, acting as firm support, failed to accelerate below, held above, went right to it, clearly underneath. I think 218.50 still holds a special spot on the IWM hourly chart here. So watching that more closely. Let's quickly take a look at what's happening with the intraday anchored VWAP. It's entirely clustered right here at the 218.50. I think it reinforces the idea that it's still kind of a key level. As long as we're above, I think the argument is this, right? Obviously, straight up continuation is going to be bullish for the S&P 500 inherently, and I would be much more concerned about the S&P 500 if small caps completely reversed this move, got consolidation below 218.50, and broke down underneath 215, right? We just talked about what goes straight up comes straight down, so on and so forth, right? So 215, key level still out of IWM. Let's get on over to the Russell internal side of things and see what's going on from that perspective. Strong volume inflows, not quite up towards 125 million, but definitely stronger than anything else we'd seen on the week. Advanced decline line is in trend higher zone, and the cumulative build at least closes positive. I'm not going to call this a strong build, especially with the afternoon sort of going sideways. At least it didn't get back down towards zero, but honestly, considering that the market did continue to grind into the afternoon afternoon. A better looking build would have been more of a 45-degree line here, not a taper into the afternoon. So carrying that forward, and keep in mind, like a strong breakout can digest. A pullback here is totally reasonable out of the Russell, which we've just sort of described on the hourly chart anyways, where that key higher low has to hold. Let's check in on the Rusty Russell futures and see what's going on from a market profile perspective. We've got a thin and drawn out market profile, much more indicative of a trend day, which makes sense based on what we just saw on the hourly charts here. What I love about the chart is just honestly that the point of control did migrate higher with price. Value is absolutely higher with price. You can see that value is very overlapping in that choppy zone we were just talking about on the hourly. Notice that value is mostly unchanged through here, slightly lower. The fact that it's much higher over all of the previous value from in here does strike me as constructive in the upward direction. Once again, overall, the theme of the Russell small caps is that they will continuously support on the bull side continuation to blue sky territories in the S&P 500 unless there's a dramatic change in tone from Friday's breakout, which as of right now, as we walk through in the internals and value here, does not seem like a higher probability outcome. Let's quickly check in on the sectors and see what's going on from that point of view. Thank you guys for bearing with me on a late Saturday upload. I know that Thinkorswim was down for maintenance earlier. So who's leading, who's losing, and where is the weight? Semiconductors lead the pack here, up 4.12% on the week, followed by the tech sector, followed by industrials. All of those are heavier weight risk on sectors. The XLF is even stacked up here towards the top, 1.88%, with JP Morgan really pedal to the metal on the long side on Friday, up 3%, more than 3% on Friday. So awesome move there out of financials, breaking out of a very clear shelf of resistance. We'll talk about that in a moment. The bottom end of the barrel is utilities. It's the TLT, which is not an S&P sector, of course, but then it's energy and communications. So you're not really seeing like a huge risk-off posture as the market's breaking out towards highs. This is absolutely supportive of the market breakout being real, authentic, having some power behind it. You're seeing the heavyweight sectors lead the pack. Let's quickly check in on the semiconductors because I do believe this can fuel the QQQ and honestly the S&P higher in the coming weeks worth of trade. Notice this breakout level. Previous resistance acted as support, acted as resistance, resistance, resistance. You've got a couple touches there. Test on Friday. Technically closes above. You've got lows, higher lows, higher lows, higher lows. It looks to me either like a huge double bottom or just an ascending triangle if you want to do something that looks like this. Here, of course, is the double bottom. If you can get through the neckline, the breakout level, 255.70. Once again, we do have a technical close above on Friday. What do we have overhead? Thin structure gap close, right? We're looking at least 264.15, if not the closure at 270.34. That is certainly attractive for bullish pressure in the S&P and the Nasdaq. So watching that very closely. If it does pull back, I'm still okay with a potential higher low as long as it's over 245, something that looks like this, equal high, and then it's like a very nuanced ascending triangle. That's a very sloppy drawing, but you get the gist. Here, equal high, and then we'll try it again, something that does this over time. I would be much more concerned about the semiconductor ETF if we see price acceptance underneath 237. That would obviously require quite a bit of bearish pressure if that's going to happen over the next couple of trading days, right? You've also got your daily 50 SMA down here. If we're under 237, the argument is just that, hey, it's a rejection of this breakout point. It's probably triggering a double top as well, 1 and 2. Underneath the neckline, the daily trend changes back to down. Right? So SMH is a top watch this week for those exact reasons. Does look more bullish than bearish to me. XLK has already closed a majority of its overhead gap. So if you're thinking about this in terms of how it relates to semiconductors, look at what's going on here. You've got a break. You've got continuation through the gap close. It looks good. We've just produced a higher high in the trend count. You've got highs, higher highs, and the highest high. So what does that mean? Any higher lows stand as continuation of the trend. As long as we're over 224.75, good to go out of the XLK. This is the heaviest weight risk on sector for the market. It looks bullish. Next up, XLI Industrials. How does this look? Absolutely bullish as it breaks out to blue sky territories. Not much to say other than this is fine, or even this from a weekly perspective is also fine. Let's quickly check in on financials. The reason I say quick is because there's not much to talk about as we're moving to blue sky territories. Nice breakout through the equal highs. Once again, an awesome sort of illustration of an ascending triangle where you have lows, higher lows, higher lows. You can only knock on the door so many times before someone opens up. Bank earnings were enough to really kick the door down instead of just open it gently. Nice break, all-time highs. So what do we want to watch for? Obviously this, or just straight up continuation in the first place. I would be much more concerned about financials if there's a move underneath 45.75 with a lower high. Now you're talking about a daily look above and fail, and you're probably thinking about targets down here at 44 flat. That would be bearish. Let's move along to the XLV. What's going on with healthcare, the third heaviest weight sector by market cap? How are we making out? We're neutral in this range. This, of course, is back to upside pressure for the S&P. The only time I'm concerned is on a lower high accepting underneath 150, 150. We're not there yet. The chart looks fine. It's technically a defensive sector, so if it lags a little bit, the S&P making new highs, not a big concern. Let's quickly check in on materials because it's the lightest weight sector to me. It's a textbook play. Here's your break, Brigade bolt above, looking for equal highs and new all-time highs over time. Looks great. Buyable pullback in here. Continuation to the upside. Lightweight sector, not really going to move the needle though for the S&P 500. The real estate sector is lagging a little bit as rates have sort of upticked, which we'll talk about when we get to the TNX, but generally inside of this consolidation is not moving the needle for the S&P. Upside pressure is upside pressure. I'd be more concerned if real estate finds acceptance underneath this breakout shelf, which is 4210. We're just not there yet, and I would really doubt, unless there's a huge move out of rates to the upside this week, which we don't really have catalysts that would suggest that, I would really doubt that something like this unfolds this week. And once again, a lightweight sector for the S&P. XLP, not materials, but rather consumer staples, has the opportunity to break out and get back through some thin structure here. If that takes place, great. Upside pressure for the S&P. As long as it's not leading the charge at new all-time highs, fine. Not really concerned from a posture perspective. Where would it be concerning from a bearish perspective? If we get here and reject, it's worth making note at least that consumer staples are rejecting a neckline of what was once left head, right shoulder, neckline of the head and shoulders, boom. That's 82.55. So watching that, but first interpretation is probably bullish to here. If it finds a higher low above, this is just back to being bullish pressure for the S&P as an index. Utilities look fine near the all-time highs, pulling back to the previous all-time high. It's the most bond-like sector. It is D for defensive. It's lightweight. Not really concerned with the pullback over here. As long as it consolidates, this just has so much opportunity to build out like weekly consolidation, heck, even monthly consolidation. This has been a massive run, right? Since July, huge rally to the upside here. So a pullback is absolutely fine, and it doesn't have a lot of influence over the S&P. Sorry, we skipped the TLT. This breaking down is worth keeping tabs on. The fact that bonds are aggressively moving lower here underneath 94.50 on the longer end. Remember, the TLT is roughly around the 20-year side of treasuries here. So on the longer end of the curve coming down, at least bond-wise, interest rates are going up, right? Inverse to this. But this breakdown here starts to signal maybe some market fears about potential inflation resurgence. Now, we did get the report on Thursday, and we'll talk more about it when we get into the TNX and sort of the fundamental take here on the market. But generally speaking, if this can support the trend line and kind of stabilize and go sideways in here, I wouldn't really be overly concerned about the bond market pricing in, oh my goodness, inflation wave 2. Next up, energy. What's going on over here? Energy did not really show up in the inflation report, which is not a shocker, considering that the most recent move was really into the end of September. But anyways, from a technical perspective, a beautiful higher low. If this builds out consolidation and acceptance over this level right here, I don't know why you wouldn't be bullish on energy here. If we take a look at the crude contract, this is also supporting over a key level. Remember that we had been talking about this shelf right here. Notice the higher low retest. As long as that holds, I would continue to expect upside pressure in energy, which is kind of like a neutral to maybe slightly bullish indication for the S&P, noting what we know about energy demand globally. If crude can hold this, which is not due to supply restrictions, but rather just demand, that sort of, again, whittles away a little bit at the recessionary theme indications. Let's quickly take a look at communications, just sort of coiled up here underneath the all-time high. It looks good for consolidation breakout, of course. If the baton is passed from, like, let's just say tech cools off a little bit and the baton is passed to communications on a breakout, or say financials consolidate over the breakout and communications breakout, you're going to continue to see a bullish S&P 500. So the sectors here really look, there's nothing bearish to say about the sectors. There's no reason to believe that the S&P should be this massive short as we're pushing into new all-time highs because, like, oh my goodness, the tech sector is the only name that looks good. Everything else is in a technical downtrend. It's not the case at all. Everything, like really a broad scope of all these sectors look pretty good in terms of their trend analysis. Same thing here out of the XLY. Plenty of opportunity here for a potential higher low over 193.50. We all know what happened on, Thursday night headed into Friday, the robo-taxi event for Tesla. So we'll let that be. But generally, in this consolidation, not concerned yet. I'd be more concerned if we got a test of 188.75 and then produced a lower high here. Right, this starts to suggest the possibility of a stronger weekly reversal, not finding acceptance back above that pivot. Once again, 193.50. But so far, so good, getting consolidation inside of the range. Let's take a quick look through the ratio grid. and see what's going on from this perspective. So if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner on how to set it up in Thinkorswim. This is progress. This is absolutely progress out of the XLK. I like the fact that we have lows, higher lows, technically a higher low, highs, and higher highs. We're back above and now flattened out, maybe slightly upward sloping 50 SMA. This is progress that's absolutely more risk on than risk off. I like that financials on the breakout are back over the 50 SMA, so we'll put a check mark here. XLV is technically D for defensive, so seeing this sideways underneath the 50 SMA, not a concern. And if we look at the XLY, ideally this finds a higher low. Once again, with the underperformance from Tesla headed into Friday, you're going to get some pain here, at least on the ratio itself. But if this can hold and make a move back to the upside, that would also look a little bit more risk on than risk off. So as we evaluate the top 4 boxes, we haven't really been able to say this in a long time, it's pretty much looking more risk on than risk off, right? Especially when we consider that XLP is in a downtrend here, the XLU is backing off underneath the 50 SMA. This is progress. We're not really seeing these risk off threats with utilities hanging near the highs or even consumer staples hanging out near the highs. Let's move along to the specialized ratios and see what's going on from this perspective. So first and foremost, we have SHY treasuries, basically 1 to 3 years, versus the XLK tech sector. Of course, nice little breakout in the upward direction. That, of course, is a risk on indication. Let's move to the right. This is utilities relative to the tech sector. New swing high. This is exactly what we were looking for. More risk on than risk off. Let's take a look at consumer staples versus consumer discretionary. Pulling back, but really so this consolidation in the context of that big breakout, once again, does strike me as more risk on than risk off. And notice over here, finally have it, a little bit of a move through the previous pivot high. So this also looking a little bit more risk on than risk off. This is semiconductors versus healthcare. So I would argue that things have improved, absolutely, as the market's broken out to new all-time highs. This is not something you should be aggressively fading and saying like, oh my God, I don't trust it. No, on this breakout, we are seeing the proper rotation. I've got to resave this grid, but we'll go emerging markets down here. You're not really seeing a huge deterioration as we consolidate the gains of the massive push up and over 42. So no issues out of emerging markets either from a risk on versus risk off perspective. Let's quickly check in on Qs versus small caps because this is starting to creep ever so slightly in the upward direction. Remember that generally speaking, the Nasdaq should outperform small caps in a raging bull market where growth stocks are obviously being valued quite favorably. So as this moves higher, you're probably in more of a bullish environment than a bearish one, and you probably want to avoid over allocating to small caps when the ratio is looking this way. Let's take a look through the dollar and get into some of the fundamentals here. Continuing to move in the upward direction, technically tightening financial conditions here inadvertently. So the technical break up and over this, you could consider it a double bottom neckline, looks fine. Any higher low pullbacks really just, to me, play ping pong in this long-standing balance range, which makes sense. We know that inflation it's continued to ease a little bit, but I wouldn't say that the report on the Thursday session was stellar by any stretch of the imagination. The biggest thing in there is really housing services coming down pretty substantially. So we'll take a look at the report in just a second, but let's quickly check in on gold, just making note that the ratio is still not signaling a risk-off indication, even as gold is breaking back to the upside. So remember that this is gold relative to the S&P. It's underperforming. Right? It's underperforming on this breakdown here. So it's not a true flight to safety, like let's grab hard assets and, stay in gold. It's really a technical breakout more so than anything. That's been our thesis for a while. The 10-year interest rate is continuing to move in the upward direction. Remember that, this is ultimately pricing in 125 basis points of Fed cuts into the end of the year, and now we're not pricing that in at all. So this creep back to the upside makes sense to me. One of the things that I think we want to consider here is what happens on the longer end of the curve. If we look, so the 10 year is kind of like in the middle. If we look at the inverted ZT, which is the short end, this is the 2 year, this is sort of like topping out a little bit here. And if we look at, let's go ZB, /ZB, for bonds, this is the 30-year Treasury. So if this starts to make a move all the way down towards this, now I'd start to have some much larger concerns about, okay, the market is more scared about the potential for inflation to resurge. The neutral rate, the market's pricing in that the neutral rate is much higher than it currently is when the longer end of the curve is acting so sensitively to this information. So watching this closely, you're in a very aggressive downtrend here. You have technically broken down underneath previous resistance, now, resistance. It was not acting as support in this most recent interaction. I'd be monitoring the long end of the curve here, and I'll continue to keep you posted in the update videos, but obviously this isn't going to correlate to an exact yield, but you get the idea. This moving to the downside means that your 30-year rate is going to move to the upside. Let's quickly check in on, let's jump on over to the Fed tracker tool as we're on our fundamental tangent here. As we can see, the market is continuously pricing in the higher odds of a 25 basis point cut, 0 odds of a 50 basis point cut, and even some odds of a pause. Now, the pause, of course, is interesting because that would continue to suggest that the bond market's going to continue selling, yields will continue to move in the upward direction, which is going to tighten financial conditions, which again is a bit of a head scratcher as we're thinking about the S&P trading near all-time highs. But I think you have to disjoint the fundamentals from the technicals until they align, right? When and if there's a technical breakdown of SPY 566, let's call it, and we also understand that, hey, the fundamentals are suggesting tight financial policy, that's probably where you look for the short as the Goldilocks situation kind of evaporates. This market's got a sick and twisted obsession with free money. The fact that we're sort of taking rate cuts off the table, market probably doesn't like too much if we break key structure and stronger sellers come in. But as of right now, through the technical analysis we've just done, there really aren't stronger sellers here yet. It's not like I would just be shorting this market as it's trading near highs based on this information. It's just good context to have when and if we need to change our tone. So speaking of the fundamentals, let's talk about CPI. This came out, of course, on the Thursday session. And honestly, it wasn't even the main event. I mean, we had talked about how the Bloomberg swaps were pricing in a 1.6, which would round to a 0.2. That's exactly what we got here. We had talked about how the Bloomberg swaps were pricing in a 2.37, rounding to a headline 2.4. It's exactly what we got. So not a shocker. The shocker is the initial jobless claims missing for the first time in a long time, 258,000 versus the 231,000 over here. If we open up this chart, right, just look at the magnitude of this miss. Now, don't worry, because I don't think it's the end of the world. I think it has a lot to do with the weather we've seen on the eastern seaboard, specifically southeast. A lot of displacement from work with the hurricanes that have been rolling through Florida, up through North Carolina, Tennessee, of course, and we've got some evidence that supports that. PPI also came in better than the expectations down here. I shouldn't say also because nothing else came in better than the expectations, but came in better than the expectation on the month over month, and the core month over month was pretty stable. So as we're thinking forward about producer price index possibly having some impact over services, that's a step in the right direction. Consumer sentiment wasn't great. It was a downtick here and an uptick out of inflation expectations from those preliminary reads out of University of Michigan. But let's dive into some of the nuances. So first and foremost, here is, generally speaking, core services still acting as the big drag on inflation, preventing inflation from getting all the way back down to the Fed's target of 2%. You can see that we are continuously getting some energy and food deflation. Sorry, that is core goods in purple, not food in blue. But core goods and energy deflation, which is helping, but you're not really at a point where I think the Fed has a clear path to 2. I think that this is more so stable and stagnating than anything else. The PPI helps, but if we take a look through this, the biggest deal out of the CPI, this is the report of CPI, is shelter. Right here. Notice that we were pretty concerned about the uptick from 0.2, a double to 0.4, and then another uptick of 10 basis points to 0.5. The fact that it was cut more than in half to a 0.2, it's a step in the right direction, but I almost want to put my Jerome Powell hat on for a second and just say, it's one data point. It's one report. One report does not necessarily make a trend, right? You saw over here 0.4 to 0.2 immediately accelerate back to a 0.4. So I'm going to say I'm a little bit data dependent on shelter inflation continually coming down. There's a great study that Mott Capital, Michael over at Mott Capital has done. If you take the market, the owner's equivalent rents, right, component of CPI, and you marry it up with basically where rents are trending out of something like the Zori, the Zillow Rent Index, what that will show you is that there's about a 12 to 16 month lag. And that actually is starting to suggest that this is likely bottomed home prices. You could do the same thing with, I believe it's the Case-Shiller index. And if that's the case, then once again, one print here not making a trend means that this could see an uptick over the next couple of reports. And I'm a believer that shelter inflation is the biggest threat to this soft landing that we're really trying to navigate here. Some other noteworthy things, energy deflation is absolutely real here. We'll see if that picks up for the next report. We know it's volatile. It's not included in the core. What else is going on here that's substantial? This is all energy stuff. As we take a look at apparel, big uptick here. We'll see if that's a seasonality thing that's going to get adjusted. And then transportation services, also pretty major uptick at a 1.4. Worth keeping an eye on that. But generally, shelter has some of the biggest impact on the report ultimately. So let's start talking about the labor market, because this is kind of what we had been tracking, right? Generally speaking, this move to the downside was like, okay, we're getting our Goldilocks situation. You're not really seeing massive unemployment. It's very unlikely that you drift into a recession if that's the case. Now, you can see here that I was pretty concerned that jobless claims skyrocketed in the upward direction. But again, based on some of the weather patterns and what's been going on with the longshoreman strike, if you're familiar with the port closures, right, you can see here that generally speaking, the South Atlantic contributions to jobless claims are really where you see the most impact specifically. And again, certainly our biggest support to North Carolina, all the folks impacted from Helen. I know that the aftermath of that is still absolutely going on. Anybody, not just North Carolinians, if that's how you say it, but you can see they're the largest impact, right? What I'm getting at is that the initial jobless claims, big miss, might not be a systemic change in what we see out of the labor market. It might just be more of a weather impact here. And again, I think that that's probably worth making note of. Same thing with Florida, 9.4. Just relative to the previous range, you can see how much of an uptick the delta is there. So just pointing out that we'd like to see this normalize over the next little bit. Obviously, it's not going to be easy for these communities to just rebuild so quickly and see the data come back to normal. So we just want to be sort of mindful of this as we're considering the potential for recession. With that, we'll move into earnings, because JP Morgan kicked it all off on Friday. We'll take a look at the chart in just a moment, but this is the upcoming week. What do we have to pay attention to? A couple of honorable mentions here. We've got United Health Group, because it's got a pretty decent influence over the S&P 500. The old guard, Bank of America, is reporting on Tuesday before the open as well. Goldman Sachs is going to be thrown into the mix. And then the two big ones that I would encourage you to pay attention to are ASML as well as TSMC. Taiwan Semiconductor, right? And ASML, they're both sort of chip producers, and they might give us some sort of insight as to how the one stock to rule them all, NVIDIA, might report further on down the line. Same thing with AMD. Just generally the semiconductor space, interested to see how these two in particular kick off the earnings season. Those really capture my attention. Netflix, of course, is, used to be the Fang Man stocks, right? Netflix was thrown in the mix, but Netflix has had a mind of its own recently. We'll see if it really gets in gear after earnings. It's been consolidating in this bull flag on the daily for quite some time. One honorable mention to the healthcare sector outside of United Health is just Abbott. Abbott's a pretty classic, long-term dividend payer, so watching out to see how they report as well. Let's get back on over to the platform and finish up the technical view of the market for this afternoon's analysis. What do we see out of the TLT ratio to the S&P? Continued to break down here, which would suggest strong risk appetite for equities down below. Let's move along to the bonds relative to themselves. Once again, this longer end of the curve, seeing that preference move out there, is becoming slightly concerning, right? Generally speaking, as the longer end of the curve, this is the opposite. My apologies. So TLT, IEF, you got 20-year versus 7 to 10-year. So you're seeing preference come in for the shorter end because rates are moving higher there, but they're also still moving higher on the longer end, which is what I was trying to articulate when we were talking about the ZB. Right. And that sort of market fear of okay, let's try to capture some yield on the short end, but also on the long end, if it continues to move higher, inflation wave 2.0, the market's trying to do Jerome Powell's job for him basically by suggesting that the neutral rate should be higher than it is currently, even without issuing some of the rate cuts that were being priced in. Of course, the rate cuts. Man, you can tell it's late. We're recording on 7:30 on a Saturday. This is not my typical time. Let's keep the show on the road though, and let's not break the fourth wall too much. Credit spreads are continuing to move in the downward direction, which is a bullish indication for equities down below. We'll keep it simple. We'll try not to drag this on for any longer than it has to go. HYG, we've got ourselves a double bottom. As long as it can hold, I would like to see an equal high like ASAP. Remember that this has been divergent for quite some time. So it wouldn't be crazy if the S&P 500 pulls back, gets a higher low retest because of this divergence. I would say the biggest issue out of this chart would be if we set a clear lower high and make a new swing low under this. I would start to be more concerned and definitely dial back expectations of continuation out of the S&P. And the same thing here in the LQD, right? You can clearly see this breakdown here, divergent to the breakout that we've seen in the S&P index. Let's move on over to Bitcoin. This is just sort of trying to get in gear to the upside, but still stagnating sideways more so than anything else. The best move out of Bitcoin would be if this can just totally clear and make new all-time highs up and over that 74,100-ish area. Let's continue to look through at the total breadth. What do we see over here? Stagnating sideways, slight uptick out of new highs versus lows. So once again, this is probably more supportive of bullish continuation than anything else. I think through all of the data points we've looked at so far, the most bearish takeaway is probably the fundamental look, which suggests that interest rates moving higher will probably tighten financial conditions, and then also corporate grade bonds continuing to move divergently from the S&P to the downside that we just saw. Everything else really aligns with the bullish breakout we've seen so far. Even the RSP aligns, noting that we've technically broke to a new high on that Friday session. We didn't really close strongly. We closed strongly on that bar, but we didn't close firmly over the breakout level, just sort of like right on it. So watching to see if we get continuation there. Ideally, as long as this is in the box and staying over 175.80, that should be round numbers only up here in the penthouse. You guys know that. Who let that one sneak by? As long as we're over that level, still again bullish from a breadth perspective, or at least, even though you might be cautiously bullish, it's absolutely not bearish. I think that's a pretty important distinction to make. Let's take a look at the QQQE and see what's going on from this point of view. Pretty much in lockstep with the weighted down below. Take it back a little bit. The non-weighted, the equal weight, right, technically broke over this pivot high, whereas the weighted did not. So I think that really builds the case, actually, for the catch-up trade that we were talking about when we were looking at the QQQ itself. So that makes sense to me. Industrials versus transports, still divergent. Ideally, this could get in gear and start printing new highs up and over these previous highs here out of transport. So watching that somewhat closely this week just to see if it can get in gear. Let's take a quick tour through volatility. Pulling back, I don't think you're going to get a huge reprieve out of volatility ahead of the U.S. elections. I just don't think that that's in the cards right now. So, staying over 15 strikes me as being reasonable. Volatility cuts both ways. You can have volatility to the up and downside. Typically, more volatility that's spikish like this is associated with downside, but stable and higher volatility just means that you're going to get wider ranges intraday. If we take a look at something like the VVIX, what's going on from this perspective? Still, again, perpetually sort of high here. I think it makes sense with the election. So this is not like groundbreaking stuff through volatility. You're working yourself into a deeper backwardation out of the November contract specifically there. So that'll adjust afterwards. If you look at the 9 versus 30 day, still a strong contango here. And even the 1-day VIX, not the 12-day. The 1-day VIX is underneath that 1275. That's where the 12 is coming from, which kind of keeps us in a comfortable zone out of volatility. Let's check in on skew just because we talked about it when it was trading near those highs. It's still trading near these highs, which just means that people are perceiving a lot of tail risk right now, some sort of like black swan event. But just remember, as a technical indication, it's really strongest on its lows, underneath 113, not near the highs. Everybody can be scared about the potential for a black swan move, but if nothing happens, then this just simmers off and nothing really goes on. It's when everybody finally throws in the towel, you're at the bottom, everybody's capitulating, it's like, okay, things probably can't get any worse than they are right now. That's when this acts as more of a bottom finder than anything else. Let's jump on into the core list of companies and see what's going on from this perspective. Apple kicks us off here. What do we have? Multiple inside bars. You, of course, have the Thursday and Friday inside bars. Friday's technically inside Thursday, setting up a little bit of an hourly bull flag. Generally looking for the clearance of this level, 229.50 for a break into 233. That is the bullish trade early on in the week. If it just goes sideways in this range, if we take out the 2-day lows, I wouldn't be bearish, but I probably would not be as firmly looking for a bullish trade to take in here. If we take it to the hourly, we can see this is clear as day, where you're just getting, technical bull flag consolidation, looking for ideally some sort of Brigade bolt that looks like that. Doesn't look great as of the close on the Friday session, but we'll take it one day at a time. If it does break down and lower high underneath these two equal lows, probably something underneath 227.50, you could maybe Stevie Wonder it through the thin structure into something like 224.60, the bottom end of the daily balance that we were just evaluating right here, right? So Apple, really treat it as a range and probably leaning more so on the breakout as long as the inside bar consolidation continues. Microsoft can't really make up its own mind inside of this area. However, I would point out that from a trend perspective, this is a lower high underneath a previous resistance as well. So to me, it's more of this counter trend looking for continuation to the downside. We've been talking about this ever since it failed to hold over that 425.25. So as we get granular on the hourly, we can just sort of see the 2-day consolidation here. I think you want to treat it as simply a Brigade bolt on the hourly here below 413.85, trades 408. Or if we break to the upside, you might try to scalp it from A to B, but I really wouldn't try taking longs on Microsoft until there's clear acceptance over 419.75, in which case you might have left head, right shoulder, something that looks like that is in play towards 425.25. If you're under 408, the stretch target to the downside is $400.75. Let's move along to NVIDIA. The one stock to rule them all is breaking up and over these swing highs from in the past. Nice little breakout earlier on in the week and getting some bullish acceptance consolidation up here towards the highs. As we look left, it's worth pointing out that this high really represents, this is a thin structure liquidation break from the gap up to all-time highs, right? If I go to the hourly, we can see that. Liquidation break, low of the morning session, previous day's high. It was a gap fill reversal. So just pointing out why it's the 136.25 and not cherry picking that high. If we look at the current price action, I think that it's very straightforward. Any consolidation in here is absolutely bullish, looking to entertain these ideas for upside. And if you move to the downside, I would not short this underneath 134. I mean, if you want to try to scalp it from A to B, again, be my guest. But typically, I would say the better trade idea is really looking for support down here around 129.50. Back to the daily chart, we can see why previous resistance can now act as a daily high or low for potential support. Let's move along to GOOGL. What's going on? This was a catch-up trade all by itself over here. How's it acting now? I like the acceptance back over 161.50 into the end of week. It was sort of a look below and fail, supporting over the daily 200 SMA. So that's a good first step, but I think the next tradable outcome is something that looks like this, over 164.75 into 169, and then you have left, head, right shoulder, over the neckline. This thing flies. Should be careful with my words. You know, I don't like getting too emotional and saying things like that, but you get the idea. There's a breakout over 169, 173.25, and then a gap close overhead is primarily why I would use a term like this thing flies, just because we have some pretty thin structure to retrace overhead if we can get that clearance. If we do end up getting price acceptance below 161.50, I wouldn't necessarily short Google. I would tend to think more of an opportunity for a potential higher low here at 156.50 from something like a weekly perspective, right? So that's Google. No need for the hourly on that one. Amazon looks great, breaking out of this consolidation range on Friday, continuing to push to the upside. Next hurdle is up and over 189.25. If you can Brigade bolt that, you're looking into 195.75. Anything that's back underneath 186.25, I would tend to think look above and fail, and the possibility, not guarantee, but possibility of a daily lower high happening here. Let's go down to the hourly so we can see this, right? You got a strong hold on the gap up. This is Prime Day news on Thursday, right? You got the follow through on Friday. Honestly, I was kind of expecting more of that on the Thursday session, if I'm being honest, gap fill reversal, but it didn't happen. So Friday, anyways, gets that follow through. If you get a pullback, it's got to hold. It's got to hold. Otherwise, this is just overhead supply caught, and look above and fail would indicate that this is probably what we're looking for to the downside, 181.50. That's a key area of support if we just reference back to the daily time frame chart. Previous pivot high, resistance acted as support. Absolutely must hold 181.50 if this is going to remain bullish. Maybe there's something like a stronger daily double bottom that looks like this over time. But if you start to get under that level, ooh, it's looking kind of ugly back down towards this flat low here at 172.25. One step at a time, probably more bullish than bearish here to begin with out of Nancy Amazon. Let's move along to the metaverse. Speaking of bullish things, just absolutely beautiful consolidation inside of this box, looking for follow through to blue sky territories up and over 594, not touching this on the short side at all until it's underneath 561, but obviously there's a couple things that can happen before then. If the box breaks down, let it go. I would probably look for longs here on the retest of this breakout level, 574, something that looks like this. Picking it back up towards the highs. If we Brigade bolt underneath, let it go. This is a choppy range. I would not want to be short in there, especially noting the relative strength out of Meta. And then if it's a break underneath 561, which again seems aggressive as of right now, but we'll see. If we get something that looks like this, there's a thin structure retracement from A to B, but even at point B, previous all-time high, it's absolutely a weekly higher low buy, like pullback long entry at this point in time. 50 SMA will slowly catch and creep up with that over time. That's 542.50 on the downswing. But certainly in this box, absolutely more bullish than bearish until proven otherwise. You've got flat tops up here. You've got 1, 2, roughly 3. If you could just sort of consolidate and do this over time, absolutely looking for upside on that Brigade bolt over 594. Let's move along to Tesla. Not so hot there on that Friday gap down from the Robotaxi event. I mean, the event was cool. The concept was cool. I really am not too fond of the style choices of the Robo van that was unveiled. I think that generally the ideas were cool, but the style and execution doesn't really float my boat. Who am I to say? Elon Musk wants to envision a future that I'm sure is reminiscent of his childhood future dreams. Now we're speculating too much. We'll let the guy do his thing. Anyways, this was a huge inverted head and shoulders. This was the neckline of that pattern, and this was about as picture perfect of a hammer candle retest on Thursday as you could have ever wanted. Headed into Friday, the idea would have been if you opened in range, taking out the hammer high should have at least driven this into 250. Clearance of 250 brings you up here towards 266.30. Obviously not the case with the gap down. We've got to reevaluate the chart. So what does it mean? If we're just getting consolidation inside of this range, I would let it do its thing. I think the gap close is interesting. Unfortunately, now that we're below this level, you have to treat it as resistance at 234.15. A rejection lower high here gets dangerous, probably looking for 210.85. If you go through, we can certainly reevaluate and get back on the long side. But at that point, you got to certainly look for the setup in there. You can't just willy-nilly buy it on the cross up through 234.15, in my belief at least. If you're getting consolidation and then further downside, I'm a little skeptical of like a big short here out of Tesla. I mean, the move has sort of already happened. Not that you would have been positioned for that unless you just hate Tesla and, we're shorting the event ahead of time. If so, do your own thing. That's not typically how I trade, but I don't like consolidation and trying to short into these levels. I don't like this. I don't like this. I don't like the daily 200 SMA down here. I mean, there might be spots to pick off a quick intraday day trade in there, but I don't like it generally as decent short location. It seems more choppy than anything else inside of this box. So moving along to JP Morgan, let's talk about earnings. Huge push to the upside. Triggering absolutely a double bottom on the daily, huge through the neckline, straight up to the equal high. This is all-time highs, which makes sense because we know what the XLF is doing as well. So any higher lows that consolidate up here are about as bullish as it gets. You have lows, higher lows, higher lows. I would even argue that holds of this level are still incredibly bullish, 215.75. It is 100% retracement of the Friday breakout, so not ideal if it happens over the span of one day, but if you get a very orderly pullback that maybe tests, comes through a little bit, and then does one of these, I mean, I've very intentionally drawn it this way, but you get the idea. Some sort of reversal pattern off of that to set a daily higher low is very, very intriguing. If we go to the hourly, let's just check in. So huge move off the open, then sideways consolidation. This could probably act as a Stevie Wonder earlier on in the week, something like Monday if we open in the flag consolidation. Breaking 220, 225, I mean, pretty snappy move from at least A to B. That's about 4 points, not quite, a little less than 4 points to the downside. They're worth trading for if it goes through. Now you're talking about more than 4 points into 215.75. So, there's an opportunity here for longs late to the party to capitulate, but certainly thinking about higher low opportunities here. Buyers, and then of course buyers down here as well if they start to show up. So thinking more about pullback longs in JP Morgan than anything else. If the consolidation persists and there is no break under 222.25, and we get something that goes, just blue sky territories, obviously bullish for the S&P as a whole. The one caveat I'll put in here is that, this would certainly trigger the Stevie Wonder. If you're underneath the 220, in theory, it could be a short. But if you have to stop out of that as it just sort of like consolidates back in here, again, the whole point of a Stevie Wonder is that it's sized for zero. But if it does look below and fail the flag consolidation range, that probably has me on high alert for a possible break to blue sky territories. Just noting that longs are not capitulating. Like the idea here is that longs late to the party don't care, right? They're staying long the name and they're not selling as you take that level out. So they have higher conviction. I would tend to think that's more indicative of stronger new money buyers getting involved. Anyways, that's JP Morgan. Netflix earnings this week, something to make note of. The options chain will get a little bit funky as we get towards earnings. Trying to break out of this range, not the cleanest hold on Friday of 724.50. I'm somewhat interested to see how it acts after earnings. So here's earnings gap down, gets into a mind of its own. Here's earnings, sort of grind to the downside, capitulate gap down, big mind of its own. So I'm curious to see if this just sort of is lackluster and then post earnings can go on one of these tirades in the upward direction. I'd be interested in that. Obviously, it would be a blue sky breakout up and over sort of this 724.50 if it were to take place in the first place. Next up, let's take a look at AMD. So for that reason, Netflix is pretty low on the list right now of things to trade. AMD, how are we doing over here? I like the pullback. I like the higher low. I like the hold of the daily 200 SMA. It's all about picking a new spot now to potentially get long AMD. I think there was a decent move, obviously, on Friday off of this area. So kudos to anybody who bought this sort of, move to the upside there. But generally, now that we're here, I think that the long has played. Like the risk reward was here, right? The risk reward for a new long is not literally at resistance. So it's either going to consolidate, find an arbitrary higher low, and then maybe we get involved on some sort of like, Brigade bolt up and over 169.75. So one step at a time here out of AMD. I don't think it's not suggesting a clean entry right now. If you wanted to play contrarian and say, no, Matt, this is absolutely a short for, highs, lower highs, risk, reward back to the downside, I mean, be my guest, but based on what I can see out of the daily chart, you're fighting a pretty decent uptrend here out of AMD. I've got one trade idea, but before we do it, I'm actually going to take a tour with you through the EnCore list, just because AVGO has been setting up quite nicely here, and that's certainly on the EnCore list. But daily hammer on the Friday session, supportive over this previous pivot high. I'd ideally like to see this continue back up towards this high, and then this is a 3-bar play breakout to blue sky territories up and over 186.50. So the chart looks awesome here out of AVGO. Generally speaking, this paired with the SMH breaking out over its sort of neckline or flat top from the ascending triangle. I like the idea here in the semiconductor space, and AVGO absolutely has some relative strength trading near these highs. So once again, the idea would be to get here, and then consolidation goes through for some sort of all-time high breakout. SMCI has been pretty lackluster. We'll go back to dailies just to talk about it. Nothing to really do over here. Maybe it's handling. You could call it cup and handle, possible, something like this. But why would you try to long the relatively weak name? I would stick with AVGO. Micron, similar story as to SMCI. In a picture-perfect world, this would have held up here and then gone higher through the thin structure to close the gap. Sort of AVGO still looks better. Palantir, strong near the highs. Pullback seems reasonable. Oracle is also a great name, very similar to AVGO, but a little bit different in terms of its exact sector. But look at this consolidation. If we can get some firmer price acceptance over 176, I would be gunning for this all-time high. 178.25 is certainly well within reason of what could be a target, right? Something that looks like this. I'd be neutral through here, remaining bullish. And then if we get a pullback under 173.75, daily high or low can still technically be found over this level here. 170.25 would be the line in the sand. CrowdStrike has played not as interested. Risk reward for new longs up here is not as ideal as when we were trading in the inverted head and shoulders. So if you got it, kudos. If not, I wouldn't chase it here. Palo Alto's had a mind of its own. Coinbase, TSM is worth talking about earnings on the Thursday session. This is very similar to AVGO with some relative strength here near these highs. I might start to dial back some expectations given that earnings are this week here, Thursday. Let's take a look at Qualcomm. Nothing to report here. So the single trade idea I had for you is on Visa. Remember that Visa sort of suffered this massive move to the downside on the investigation. And of course, there was some inside selling there that happened the day prior. But anyways, over 278 gets interesting for the gap close. So just watching that, we know that the XLF sector as a whole is looking pretty strong right now. Let's get rid of that. What I was looking for is that drawing tool. There we go. Ascending triangle. I think it's a very simple setup to watch, but this sort of idea here to close the gap is worth monitoring. Remember that Visa and MasterCard had been inducted into the XLF financials. They were originally in the XLK technology sector, and I think it's more fitting. So if this does break out, it's probably going to continuously fuel the fire for new highs out of the S&P 500, adding to upward pressure in the XLF as a sector overall. That's going to do it for today's episode of the Weekend Update. I know it's a late one, and again, I appreciate you guys bearing with me as Thinkorswim was down for some maintenance. If you enjoyed the video or learned anything new today, let me know down below in the comments section or by giving the video a very simple thumbs up. I hope to see you all in the penthouse early on Monday morning. The market is not closed on Monday. The bond market is closed. It is a bank holiday. Bond markets are closed. The market itself, equities markets, are not closed. So we will be streaming up in the penthouse, 8 o'clock per usual on Monday morning. We'll see you for the pre-market prep. If I don't see you, I hope you have a green trading week, and I will see you hopefully in the next one.